First Bank of Nigeria produced weaker than expected third quarter results. Joining me now is Bisi Onasanya, the CEO of the First Bank of Nigeria. Bisi, thanks so much for joining us today. Let's start off with gross earnings, which sit at 54.7 billion naira, year on year down around 18%, quarter on quarter down 9%. What contributed to the drop in gross earnings for this quarter?
Yeah, the Nigerian economy in the past 6 months, we've had liquidity glut in the system. And for a major player like First Bank, where we are major placers of funds in the market, the reduction in interest rates accounted significantly to the reduction in earnings. We also noticed some reduction in earnings in terms of non-interest income as a result of the lull in the economy during this particular point in time. The good news, however, is that this situation has improved and we have moved into an era of an appropriately priced interest regime. You know, the central bank also increased the benchmark rates recently, and that has helped us in the last quarter of the year.
Well, let's touch on interest income, which we know came in down 20% year on year. So that there being a decline, you're saying that there is good news and things are going to start turning around. When you say turn around, to what extent? I mean, what kind of numbers can we expect going forward?
I'll give you an example. In the third quarter, throughout the third quarter, overnight interest rates was about 1.5% to 2%. Today we are talking about 8%. That's a significant movement from where we are. Now, this on its own needs to be related to the economic inflation rate in the economy. You have an economy with a 13-14% inflation rate with interest in the region of 8-9%. There's an imbalance there. But the good news is that these rates have moved up to some extent, and we suffered that significantly in the third quarter because of the liquidity glut in the system and reduced interest rate due to low activities in the real sectors of the economy.
And I suppose
that affected us.
Well, that's of course being shown in net interest income growing by 8% quarter on quarter. So clearly it is starting to filter through because year on year it came in up 1%, which is basically flat. Let's touch on loans and deposits because we did see a growth there quarter on quarter. Loan book up 5% quarter on quarter, deposits up 9% quarter on quarter. Tell us about market segmentation then, where you're seeing the most demand coming through and of course the most deposits coming through.
Now, most of the deposits, as a deliberate policy, came in from the low-cost deposits end, essentially savings deposits and demand deposits. Now, the bank obviously has started reaping the benefits of its resilience and good rating in the system and very strong brand. As of today, about 85% of our total deposits are in the low-cost end of the deposit market, which is essentially savings and current accounts. On the loan side, there's an equal distribution between loans in the corporate sector, the consumer sector, and the retail sector, but much more from the corporate end of the market. This is a deliberate policy to balance our portfolio and make sure that we have a portfolio at the end of the year that is proportionally distributed between the various market segments. As you know, the corporate end of the market is less risky, but the yields on that sector also are much, much lower than you have in the retail end of the market. But at the end of it all, you have a balanced portfolio and the risk profile is also balanced. So it's a deliberate policy, and that's where we are today.
Let's touch on non-performing loans because they have stabilized. But when do you expect these numbers to come down? Because just like all the other banks in Nigeria, it's still one of those issues that many have to see start filtering through. In other words, becoming better down the line.
Now, the reduction in interest rates was not just on one side. Deposit liabilities were lowly priced, so also it's a deliberate policy on the part of the banks, particularly First Bank, to stimulate the economy by reducing interest rates to the real sector. So what we've had also is that for us as an institution, our prime lending rate has reduced from the mid-20s that existed about 1 year ago. Now we are proud to say we have customers borrowing from us at 12%, some 13%. So with the reduction in interest rates, we are helping the economy, but at the same time, we're also de-risking the size of our portfolio because sometimes the reason for delinquency in some of these loans may not totally be unrelated to the ability of the customer to pay in relation to the viability of the underlying business.
But see, let's just touch on, the fact that the NPL scenario has declined significantly from December 2009. Is this because of classification of the loans, or is it because you've actually seen recoveries coming through?
It's a combination of the two factors. We have write-backs and we have recoveries. So those are the two factors. We have about 28 billion naira right back on loans, and we also have significant recoveries, and we will continue to pursue recoveries. That also affected the total loan growth that you saw, because the loan book that you have seen is net of recoveries and provisions. So if you factor the recoveries, provisions, and right backs, the loan growth is actually much more than the 50 billion naira that you saw on the balance sheet.
Coverage ratio sitting at 71%. Some would say that it implies a fairly conservative loan provision. What level of recoveries can we anticipate for the fourth quarter of 2010?
Yeah, what we need to understand is that the provisioning itself is guided by the CBN prudential guidelines, and we can confirm that our coverage at 72% today is totally in line with the prudential guideline. You need to move up if the quality of your portfolio is worse. If you have 100% migration to loss category, of course, you need to move your loan loss coverage from 72%. But as we are today, we are quite comfortable and we are fully in compliance with the CBN prudential guideline. I don't think there will be significant improvement or increase along this coverage ratio. I expect it to be flat at between 70 and 75% to the end of the year, because we don't expect major deterioration in asset quality between now and the end of the year.
Let's touch on rescued banks and whether First Bank is going to be interested in any of the rescued banks.
Like I've always said, we will continue to look at the rescued banks. We have an interest in a particular one. We are still in discussions. We have not closed a deal yet. We will only close a deal if the terms are good enough for us and it enhances shareholder value. Everything we are looking at in this kind of transaction is a transaction that will improve and enhance our shareholder value. As we speak today, we don't have a deal. If the situation improves, we'll let you know. But we are in the game at this moment.
Hopefully you'll let CNBC Africa know first, of course, BC. Let's touch on the cost-to-income ratio, slightly higher at 64%, a target for the fourth quarter and beyond. What are you looking at right now? And I was talking to some analysts earlier this week, and when it comes to Nigerian banks, they're saying, yes, we're seeing cost-cutting coming through. We're starting to see some recovery coming through on the bottom line, but top line, still very much an issue. So a lot needs to be done to really change the scenario around.
Until we solve and deal with the issue of infrastructures in Nigeria, the cost-income ratio of Nigerian banks will be disproportionate in relation to the international banks. But what we expect for First Bank is a flattening out at the existing 64%. Our target for the year end is 60%, but it's a combination of enhancing our revenue and also trying to see where we can save cost. But built into our own cost profile is also inclusive of our transformation costs. There are a lot of things going on in the bank today, and these are things that we need to do to get the bank prepared for the challenges of tomorrow. And that on its own also is built into our cost profile for today. Otherwise, it would have been much lower than the 64% that we see. So forecast for year end between 64 and 60% going forward.